Welcome to The Explainer. Today, we are absolutely cracking the code on home loan applications. We're going to break down exactly what income documents Commbank needs, looking at it from every angle, depending on how you earn your money, so you know precisely what to have ready.
Everything the bank asks you for, every single piece of paper, it all comes back to this one fundamental question. Seriously, it's the why behind all the paperwork we're about to get into.
So here's our game plan. We'll kick off with the main idea, then we'll walk through each type of employment, from your standard 9-to-5er to being your own boss, so you can pinpoint exactly what applies to you. And we'll wrap it all up with a super handy checklist.
Okay, let's dive right in. The entire way the bank thinks about your application is built around this one single concept: serviceability.
So what does that actually mean? Well, in the simplest terms, it's not just about what you earn, it's about what's left over at the end of the day. The bank has to be totally confident that you can service or, comfortably make payments on that loan for the long haul. That's why they dig into your income so carefully. All right, let's start with the most common and, honestly, the most straightforward group: standard pay-as-you-go employees. We just call them PAYG.
First things first, the bank wants to lock in your stable, guaranteed income. This is your base salary. It's that amount you can count on, no matter what, before we even start talking about things like overtime or bonuses. Think of it as the foundation.
Now, here's what's really cool about this. Commbank gives you 3 different ways to prove that income. You can show 3 months of your pay just consistently hitting your bank account. You can provide a single recent payslip, or you could use a combo of your work contract and your tax summary. It gives you options, right? So if one document isn't quite right, you've got other ways to go. Now, if you're a casual or a temporary worker, the rules shift just a little bit. Because that work isn't technically guaranteed, the bank is looking for a track record, a history of consistent employment. And for them, that magic number is at least 6 months.
And this is a really important point. It's all about how you prove that 6-month history. If you've been with the same boss the whole time, a simple payslip showing your year-to-date income could be enough. But here's the great part. Even if you've changed jobs, as long as you've stayed in the same industry for those 6 months, you can actually piece it together. You can combine bank statements from your old and new jobs with a current payslip to build your case.
Okay, but what happens if a big chunk of your pay isn't that fixed salary? Let's take a look at how the bank handles all that variable stuff, like your overtime, bonuses, and commissions. The big word here is consistency. For overtime, it has to be a regular part of your job. For bonuses, they want to see it happening for at least 2 years. And you'll notice, for all of these, the bank only uses 80% of that money in their final calculation. Why? Well, they just see it as less of a sure thing than your base salaries, so they build in a little safety net. In this chart, this shows you exactly what's going on in their heads. Your base salary is rock solid, so they count 100% of it. But anything that can fluctuate, your overtime, your bonuses, they consider it a little less certain, so they shade it or discount it just to build in a buffer in case things change. And it's that exact same logic if you earn your income in a foreign currency. To protect themselves against exchange rates going up and down, the bank will automatically reduce your income by at least 20% before they even start their sums. It's all about managing that uncertainty. Okay, the world of contracting. This one can get a little tricky because, from the bank's point of view, not all contractors are the same. They make a really important distinction between 2 different types. And it all boils down to one simple thing: who's taking on the risk and doing the admin? If you're in a contract where your employer handles your tax and your super, and you're not really carrying any business risk, then hey, you're treated just like a regular PAYG employee. But if you've got an ABN, you get paid a gross amount, and you're the one responsible for tax and expenses, well, the bank sees you as a business, and you'll fall under the self-employed rules.
Now, this is super important for anyone doing seasonal work, say a fruit picker who works flat out for 3 months. You have to know the bank will not annualize your income. They won't take what you earned in 3 months and multiply it by 4 to get a yearly figure. They will only use the actual total amount you earned during that season. That's it.
And now for the big one, the most complex category of all: verifying your income when you run your own business. This is the magic number: 25%. If you own a quarter of the company that pays you, or more, then boom, you officially move into the self-employed category, and a whole different set of rules kicks in. So, as a self-employed applicant, you've got 2 roads you can go down. The simple verification path is faster. It just looks at the salary you actually pay yourself. The downside, It completely ignores any profits you've left in the business. Full verification is way more complex. It requires a deep dive into your business financials. But it allows the bank to consider your company's overall profitability, which could really boost your borrowing power. The full verification path is basically a thorough health check of your business. The bank looks at 2 years of performance, and, to be cautious, they use whichever number is lower, either your 2-year average or just your most recent year. The big benefit, though, is that they can add back certain expenses that aren't actual cash leaving the business, like depreciation. This gives them a much more accurate picture of your real cash flow.
Phew. Okay, we have covered a lot of ground. So after all that detail, what are the universal takeaways? What are the key principles that apply to pretty much every single applicant? It all really boils down to 4 golden rules. First, your documents have to be recent. This stuff needs to be fresh to be relevant. Second, consistency is king. The bank wants to see a stable pattern. Third, give them the full picture. Incomplete documents are the #1 cause of delays. And finally, just be prepared. Getting all this right up front is the single best thing you can do to make your application smooth and fast.
Look, proving your income is one of the biggest steps in any home loan application, for sure, but it absolutely does not have to be a mystery. Hopefully, this explainer has given you a really clear roadmap, giving you the clarity and, most importantly, the confidence to move forward.